Welcome back to Chapter 9 in your Cornerstones textbook. We'll deal with how we account for interest payments on a premium bond, on a bond sold for more than its par value in this video. We're going to use the straight line method again, not the effective interest rate method that's also in your chapter. We'll be focusing on the straight line method. And when we are dealing with a bond issued at premium, we have to deal with the premium amortization. Remember, interest payments are always going to be the principal times the coupon interest rate times the portion of the year over which the interest is paid. It's often every 6 months for a bond. The premium amortization will take the total premium and divide it by the total number of interest periods. So that means interest expense for every period in a premium bond's life will be the interest payment minus the premium amortization. Let's go right into Cornerstone 9.4 to see how this works. And you'll notice that it is extremely similar to working with a discount bond. We just have to remember to subtract the premium amortization from the interest payment in order to arrive at the interest expense that is debited every interest payment period. We'll deal with Farnsworth Inc. that issues a 5-year $100 million bond at 8% coupon, and it issues at 102, meaning 102% of the par value, which is $102 million. The premium then is the difference between par and the sales price, which is $2 million. And the interest will be paid semi-annually on June 30 and December 31. So first let's deal with how we record the issuance. So this is a review of how we record the issuance of a premium bond. We're going to reflect how much cash was actually received, which was $102 million. So I'm going to debit the $102 million to my cash account. And then I'm going to have to record the premium on bonds payable, which is going to be the difference between the cash I received at the time of sale and the actual liability. The liability is only ever going to be the face value or the par value, so that difference is $2 million. And the total liability here, bonds payable, is $100 million. These two credits add up to that debit. Remember, the premium on bonds payable will always be the difference between the cash received and the actual liability. And the liability, the bonds payable credit entry, will always equal the par value of the bond. So, what will be the amount of premium that's amortized every semi-annual period? Well, just like when we amortized the discount before, the premium amortization will be the total premium amount, which is $2 million, divided by the number of interest periods. Well, how many times will Farnsworth pay interest over the life of this bond? If you said 10, you're correct, because it's issuing a 5-year bond and it pays the interest semi-annually, which means twice a year or every 6 months. So that means the total premium amortization is $200,000 every single interest payment period. Now, if I know the premium amortization and I know the amount of cash of interest payment that's actually paid every interest payment period, then I can figure out the total interest expense for every semi-annual interest payment period. The interest expense will be the interest payment that's paid in cash to the bondholders minus the premium amortization, which I already learned was $200,000. So interest payment is going to be principal times coupon rate times the portion of the year that the interest payment period covers. So interest payment is going to be $4 million per period minus $200,000 of premium amortization. So I will have an interest expense on my premium bond of $3,800,000 per interest payment period. Now, just like the discount bonds, the premium bonds can show an amortization schedule that will show how this premium is going to be broken down over the time period. So in this case, over the 10 interest payment periods that are occurring on this bond. So we know that the total premium is $2 million at the start of the bond, which means the carrying value or the total amount of cash received initially is $102 million. That's at issuance. Now, in that first interest payment period, we said that the total amount of interest paid to the bondholders is $4 million. The total amount of premium that was amortized, which is a debit, by the way, is $100,000. So, $200,000. So that means the interest expense is the payment minus the premium amortization. So it was $3,800,000. This means that the premium balance, because remember, I'm trying to get that balance all the way down to zero eventually. I'm going to reduce the total balance by the $200,000 of premium amortization that just occurred. So the total premium balance will be $1,800,000, which means the carrying value of this bond will go down to $101,800,000. So let's look at how that rolls. What we end up having is, just like in the discount bond, the cash payment, because we're using the straight line method, the cash payment of interest is the same. All 10 interest payment periods. And the interest expense is going to be the same. That's because the premium amortization is the same, because we are using the straight line method. So the premium amortization is always $200,000. The interest payment is always $4 million. So $4 million minus $200,000 will always be $3.8 million. The premium balance, we know we want to get to zero. So we keep reducing it by however much premium amortization occurred in any interest payment period. And we also know that no matter how much Farnsworth received when it issued the bonds, it's only going to owe the face value or the par value by the time we get to the maturity of the bond, the due date of the bond, which means the carrying value must decrease every single interest payment period until we have hit the par value or the face value of $100 million. So while this is very similar to the discount bond, if you recall, the discount bond, the carrying value kept growing until it hit the face value. In this case, in a premium bond example, the carrying value keeps falling until it hits the face value. Now, what would be the journal entry to recognize interest payments every single semi-annual period? Well, we would have the interest expense of $3,800,000. We would have the premium amortization. Now, remember, that was initially a credit entry, so we're going to have the debit entry for $200,000. That's the premium amortization. And then we would pay cash of $4 million, because that's how much actually goes out the door to the bondholders every single interest period. How would we record the repayment of the loan? Well, whether you've got a par value bond, a discount bond, or a premium bond, the journal entry for repayment at maturity is always going to look the same. It's always going to be a debit entry to bonds payable for the full par value of the loan, in this case, or excuse me, the bond rather, so $100 million, and then a credit entry to cash for whatever the par value or face value is. Finally, your chapter deals with leases. And I'll just briefly go over this so you know how to deal with them. Leases are an alternative to outright purchasing an asset. It can be a bit like renting, though we are careful not to use that same term. There are some distinctions. When we are talking about leases, there is the lessor or the leaseor. That's the legal owner of the asset. And then we have the lessee, the individual or company that is leasing the asset. In operating leases, the lessor retains the individual or company that is the legal owner. It retains substantially all of the risks and obligations of ownership during the term of the lease. The leased asset will not appear on the balance sheet of the lessee company, and the annual lease payments will be considered an expense on the lessee's income statement. However, because most individuals and companies are aware that operating leases are binding contracts and they are a lot like having a liability, even though the asset and the liability do not show up on the lessee's balance sheet, the information on the operating lease must be disclosed in the footnotes on the company's annual statements. Now, capital leases are different. In a capital lease, it's much more like the outright purchase of the asset. Now, there's 3 characteristics that would occur for a capital lease. Number 1, the transfer of the leased asset to the lessee will occur at the end of the lease at low, or what we call a bargain cost, meaning at the end of the lease, the lessee actually gets to own the asset outright at little or no cost. A capital lease also would have a term that is at least 75% of the economic life of the leased asset. A capital lease, lastly, would have a present value. That means the present value of all the future lease payments. They would total 90% at least of the fair value of the asset. In a capital lease situation, the asset and the liability show up on the lessee's balance sheet. The lease liability is the present value of the future lease payments, and the lease asset is the same thing. And in this case, the value is depreciated over time, which means the lease liability is reduced over time, and you would record an interest expense. This concludes your videos for Chapter 9.